Hey everyone, welcome back to the Patti Martin Real Estate Group YouTube channel. Today we're joined with Michael Friedman. He's a mortgage broker in the industry for a long time. How are you doing, Michael? How many years has it been?
I'm doing good. I'm starting to lie, so I'm not going to tell you.
All we need to know is you're quite experienced.
Okay, I'll go for that.
Today's an interesting topic, and what we want to talk about is how millennial kids, adults now I should say, and Gen Z can benefit from the wealth that their parents, the baby boomers, have accumulated in real estate and investments over the past 30, 40 years. Because I found this interesting study, and it was a report from CIBC, and it was a study that was done in May 2024, and it talked about how 30% of first-time home buyers back in 2021 received a monetary gift from their parents, and that was up from 20%, which was a study done back in 2015. So we're seeing this growing trend, and we're seeing this wealth transfer from baby boomers onto the next generations. Another article came out and talked about that by 2026, there will be a transfer of nearly $1 trillion, with a T, $1 trillion from baby boomers to millennials and Gen Z. We're talking about how the average gift in other markets, and even this market, is about $115,000. And we're talking about how there is no CRA, there's no tax, income tax on gifts provided from baby boomers to their millennial kids or their Gen Z kids. So Mike, where do we even start here? How do we access this type of wealth, and how do we transfer it to the adult children?
Well, I can tell you one size does not fit all. Every person or every family is going to have a different situation. But there's generally 4 ways of gifting. One is obviously cash. The only issue with that is, as a parent, your cash might be tied up in an investment portfolio. So, the question comes: do you liquidate a portfolio that's generating you income for your retirement?
No, so if that's it's cash and the parents take it out of those funds, though, that will be hit with income tax. If it's in the RRSP or RIF or something like that.
Yeah, if it's an RRSP, but if it's in the account, like a non-RRSP, no. And then you can mix and match. So sometimes a parent may have the wealth to gift the entire amount, and they can buy the home with cash. But usually, what we see is, like you said, 115. We're seeing. It's funny you said 115. I've noticed in the last 6 months it's been like 150. I was reflecting on that as you were saying, the 115. So generally, it's the parent gives a gift of X amount, and then the kids qualify for the difference. And there's no tax implications there. The other thing we're seeing is sometimes a parent will have a home, let's say it's worth $2 or $3 million, and they'll take a mortgage on their home, and they'll gift it that way. And yeah, I know we've seen that a few times. And that is not the most common way to do it, Adam, but we are seeing that.
So then, just out of curiosity, if the parent is taking out a HELOC or a mortgage on their current home as $2 or $3 million, who's paying that mortgage?
Well, that's between the family. Right? So again, that's why I said one size does not fit all. I mean, a parent might say, I'm better not taking a mortgage on the house, and then I'll make the payments through my investment portfolio. This is where it gets a little, complex, and we've got to look at each situation differently. And we do get calls from parents asking, which way should we go? I had one actually from your office this morning, and oddly enough, the timing's good. And they thought they'd have to go one way, and I advised them it'd probably be better to go another way. So you mentioned HELOC. So I just want to make sure people understand what that is. The HELOC is a home equity line of credit. It works like a mortgage, but it's in that case, it's interest only. So the payments would be interest only. But for both of those, the mortgage and the HELOC, you have to qualify. You have to income qualify. So it's going to depend on what age the parent is to the children. So, are you retired now? It may be more difficult to qualify for a mortgage or a HELOC. And then the fourth option is a payment optional mortgage, which are also known as reverse mortgages. We call them payment optional mortgages in our practice because a lot of people don't realize that you can actually make payments on reverse mortgages. The benefit there with those is you do not have to income qualify. They do it strictly on the equity in the home. And then the children could technically make payments on that if the family wanted them
What's
to
the
do
downside?
that. Well, downside, yeah, I mean, there's always there is never an upside to borrowing money, by the way.
That interest rate is going to get you one way or the other, right?
And I've been in the business for 35 years. I just let the cat out of the bag. And cash is king. But the downsides on a payment optional mortgages is you're not making payments, so the interest balloons. But just to give you an example, if a parent was wanting to help a child now, and they couldn't income qualify, and that was the route to go, and say their home was worth $2 million. Well, that home, based on 4% appreciation over the next 10 years, would be worth close to $3 million. Oddly enough, if they took a $500,000 mortgage to help their kids maybe buy a $500,000 place, it would be a wash. The increase in value to what they would owe to the bank would be about the same. However, the kids have now bought a home for $500,000, which is probably going to be worth about $850,000 in 10 years. So you would be ahead. And with a payment optional mortgage, parents could say, well, even though we're giving you this money, we'd like you to make X amount of payments a month, which would bring down that cost of the parents paying out that mortgage in 10 years. The other thing is a benefit. So you've got pluses and negatives. Mortgages and HELOCs. Mortgages would be the cheapest interest rate, but it's principal and interest, income qualified. A HELOC, again, would be income qualified. The interest rate would be a little bit higher, but it's interest only. The only issue with those two, depending on where you're at in age, is if you have two parents if you have two parents mortgaging their home to help their kids, and one of them unfortunately passes away, when that mortgage comes up for renewal, they're going to have to either sell or requalify on that mortgage on that one income. Whereas the payment optional mortgage does not require that. It's the last living person who then would have to have, or the estate would have to be liquidated.
And what happens?
So
the state, if they don't qualify upon death and then renewal of the gifted house, essentially, what you're saying is they might
the gifted money.
The gifted money. The kids might actually have to sell that house to then.
Could be, or mom or dad, whoever's left, may have to sell that house. So there's some careful planning that has to go into this. I mean, first of all, the easiest one, the cleanest one, is obviously cash, right? Then you get into, here's the problem: is that this city, the prices are always going to go up. We've got just so much land available. Housing crunch. We're not building enough houses, and the prices are going to always continually to go. I don't know if they're going to go as fast as they did in the past, but they're going to go up. So to do nothing when there's a need is not the right answer. So there are options, but again, like I said, it's got to be tailor made for each situation, and that's where yourself as a realtor and a qualified mortgage broker can help people try and decide what's.
So here's a question for you. Maybe this is a different strategy. Would it be better for the parents to simply buy the house and then rent it to the kids? That way the parents can have the rental income, the rental offsets if they run it like a business, and then set up a will where upon death it can transfer. Like, would this factor into that instead of just gifting debt?
You got capital gains because it's a rental.
But it's a personal rental, and it would be a rental in your personal name, which means I think the limit was $250,000 of profit before you'd see any CCA.
Okay.
So an accountant would have to get involved in that. But do you think?
I'm positive because I stay in my lane.
Yeah, of course. This is just like we're spitballing here. Like, would this be another option instead of taking on?
It could be, but you'd run it through your account first. The only problem then is you've got now, the kids don't have a property in their name, right? And when you're looking at your estate planning, sometimes it's better to start transferring wealth into the next person that potentially might be able to benefit from it. Earlier do it.
So another question I have for you would be like, how often are you seeing parents helping their children purchase real estate?
A lot. A
What
lot.
like in a month, in a year, what like how often do you think you're seeing this?
Well, percentage wise, I would say for, let's call it first time home buyers, okay? I would say at least 50% of my files.
50%. That's
Yeah, I
astounding.
would say at least 50%. And I just want to clarify that's first time home buyers in the
Okay.
Vancouver market. So, if someone's watching this in Calgary, it may not be the same. But,
What
we've
about that
got
upsizer? Like somebody who's already in the market, they have a 1 or 2 bedroom, they're trying to get into that townhouse or an entry level house because they have a growing family. So now it's probably their second or third home. Minimal. Is
minimal.
that mostly because there's already
No,
equity earned and they're
yeah. And if they were past clients of mine and they listened to our suggestions on how to build equity during the process of having a mortgage, then they have that much more equity to, move up. And that is one of our goals with our clients is to pay, strategically pay down that mortgage so that you can upsize.
I know this is usually a family situation, but you're a mortgage broker. You might get involved in the nitty gritty of some family details. Are you seeing parents charge their kids interest on any of these loans? Like if they gift them $250,000 cash, like what kind of arrangements are you seeing?
Okay, so you brought up a good point because there are rules about getting gifted funds when you take a mortgage with a lender. So if you're declaring the gift as part of the mortgage process, it has to be
who's declaring the
unencumbered.
gift? Like the
So the,
okay.
the applicant. So say, uh, John and Mary Smith come to me and they say, Mom and Dad are giving us $150,000 as a gift. It's been declared as a gift with no repayment. So you're required to sign, and so are your parents will be required to sign what's known as a gift letter. Every lender's got a different one on their letterhead. The lenders also will call the letter to verify it. The lender will require to see that the applicants have received the money in their bank account before the mortgage funds. And they'll so the parents will be required to give the money to the kids in advance, put it in their account, and we'll have to verify. By the way, I do recommend if a gift is involved that the funds are transferred to the children usually right after subject removal. There's a whole bunch of reasons
Does that
why.
have to be a certain time frame? Normally, we like to see about 30 days, but
The lenders usually have a cutoff of 2 weeks, but in my experience, I guess it only takes a couple times for something to go sideways. But I've had one situation where a parent passed away before they gifted the money.
Okay.
I had another situation where the money was in investments, and the market crashed. So it's best to get the possession of that money sooner than later. So because you're in a firm contract to your subject, so it's better to have money.
Right. So as soon as you have this conversation with your parents about getting the gift, try to transfer that money almost right away.
Yeah. Talk to your mortgage broker because everyone's got a different process of how and when the gift letter is signed. But the answer is it should be moved sooner.
When because you're structuring the mortgage, but you're also seeing oftentimes when we have subject removal, we're then adding a parent to title at a later time before completion and before title registration. Would you recommend that parents go on title if they're gifting the money? I mean, we know there's tax implications and things like that, and there's other declarations you have to make through the municipalities. But generally, I would assume that the parents would want to somehow secure that $250,000 or whatever they're gifting.
It really depends on the family dynamics. So the other thing to consider too, go on title. And if a parent did go on title, I probably recommend they go on for 1% because all of a sudden now you could be subjecting your kids to paying the property transfer tax. It also depends on the price point. And the point there is if after the fact a parent wants to be out of the title, remember they've now got to go on the mortgage. They just can't go on the title. So if there's a mortgage, if you're on title, you've got to have a mortgage, which means you need to notify the mortgage broker right away because they've got to add you into the application, which opens up the whole file. So I would say that there should be some fun doing that in advance versus 12.
Yeah, I mean, this goes back to the conversation of cash is king, and if you have the cash as a gift, you can go ahead and do this. As soon as we're talking about mortgages, then it gets a little bit more complicated.
Yeah.
I think one of my last questions for you, Michael, is just future financial planning. So how can parents balance helping their children with a home purchase while also ensuring they're protecting their own financial future?
So we're talking about the children's financial
more so
future.
the parents' financial future, because I'm assuming they're retired or about to get into retirement years, and they're going to be gifting a pretty sizable gift to their kids. So how can they make sure their kids are set up to purchase this house and then just make sure that they aren't putting themselves at risk?
Well, I mean, the first thing you got to look at is, do you have the ability, is this financially feasible? I would say I'm a parent. So if I was going to cut a sizable check to my son, the first conversation I'd be having is with my financial planner. I'd be saying, like, can I do this? How is it going to affect me tax-wise? How is it going to affect me with my investments and what I pull out of it on a monthly basis? So really, when you're giving the gift, it's a gift.
Yeah, don't expect it back.
I would say, what's the old saying is that you've got some friends that if you loan them money, you might as well just say, "Here's the money," and you'll never get it back. So I would say a gift's a gift. I mean, there are some circumstances I can tell you. I do get a situation where parents will say, "We want to give them a gift, but we want it encumbered somehow." So we can have conversations with that. A lot of times it would require disclosing that to the lender, depending on what they have. I've had parents where they've gone, "Okay, here's the gift, but we want to encumber it." So we've drafted up a letter where there's no financial repayment during the mortgage period, and then the parents just wanted to get the money back upon sale, like with no interest. So not every lender will do that. So, that's really important to have a good conversation about how this gift is coming in. We usually, immediately say, like, the gift is going to be non-repayable. Is that correct? And if there's some hedging or some concern, then that's a conversation that I have with the parents to try and figure out how to craft what they're after.
So, Michael, we have some new mortgage rules that have come into effect in Canada. The cap on insured mortgages has increased from 1 million to 1.5, and they've extended the amortization now to 30 years. When we are starting to structure how we're going to be gifted the money for down payment and things like that, how does this come into play?
Well, I mean, it's really a real benefit. I mean, prior to these new rules, if you were a first-time homebuyer and you needed a gift from family, and you went 1 inch over $1 million, you had to put 20% down, right? So all of a sudden now they've increased it to $1.5 million. So that works out. The minimum is $125,000.
Right.
$1.5 million. It had been $300,000 before. So the benefit now to gifting is that all of a sudden, as a first-time buyer, you can get into that price point with a
lower monthly payment, assuming you're going to have a longer amortization, but there's going to be more interest costs in that long run, which could be significant. So getting a house over or a roof over your head is great. Getting into a home that you love is great. Into the neighborhood that you love is great. But you really have to plan ahead to try and pay down that mortgage as fast as you can.
Yeah, we for most of our clients, what we recommend is the clients pay monthly accelerated. That drops the amortization, and then there's some other tools that can be done with increasing payments slightly each year that can greatly reduce the amortization. You get into the home, you don't want to over leverage, and when you get in, you do want to try and decrease the mortgage systematically. Most people that, I'm sure, Adam, you see their first-time home buyers, they're buying a home. It's not going to be their first home.
It's not going to be their forever home.
So it's not going to be their forever home. So we want to make sure we're helping them build equity so that when they do the move up, typically in this city, it's condo, first-time home buyers, typically it's condo to townhouse to house. So how do you do that? Is you got to make sure you're building the equity up, and it's best to do it very slow. I call there, there's a terminology. There's a saying out there when you're doing investing and saving money is you pay yourself first. But you do the same thing with a mortgage. Is you need to pay a little bit extra. You just pay the minimum. It's going to take you forever to pay it off.
That's a good tip. Is there anything else that you'd like to touch on that you think that we haven't talked about when we're talking about this great wealth transfer?
It's going to increase, and I think for parents, what they have to realize is that they've done very well in their homes. They've increased greatly, but it's become a hindrance for their kids. So to balance that out, is a great way to do that.
Wonderful. It's a great information. Thank you so much for joining us today on our YouTube channel. And Michael, we'll get you back soon.